All right, so what do you make of just how investors are taking the recent tensions between the U.S. and China, some of the credit issues we just hit on just a short time ago, and of course the government shutdown going into its 20th day?
Yeah, this market has had an incredible ability to shake off all negative headlines. And we think that the reality of why it's able to do that is because positioning was so light coming out of the April Liberation Day lows. And because you had institutional investors who many of them are still sitting on the sidelines saying that I have to buy each and every dip, it just means that we're able to see this market chase and drift and even melt higher. I think the good news is that you're still seeing earnings revisions on a 12-month forward basis still push higher, which just means that there is some fundamental underpinning to this. But we have to remember that valuations are very stretched. And as we get into the beginning of 2026, it's likely we'll get to a point where positioning will become very full and very extended, which means that that could usher in more volatility. But for now, the chase is on.
All right. Seeing the potential for more volatility. And speaking of, I think that your word of the day is kind of leaning us towards your thoughts that there could be more volatility, decoupling. I'm assuming you're talking about the U.S. and China.
Yeah, well, actually, we're talking about the US economy itself. And
Oh.
decoupling really comes with this question of how long can it last? I think one of the most fascinating things over the course of the last month, even though we haven't had any economic data, has been the fact that alternative labor market indicators are still pointing to a slowdown in the US labor market. However, if we look at things like the Atlanta Fed GDP now, it's at 3.9% for this quarter, which just means that the US economy is strong, but the US labor market isn't strong, which just means that you're having this decoupling where things like AI as well as really wealthy consumers are holding the US economy up, whereas the broader economy, really captured by the labor market, is still struggling. And so I think that that decoupling is persistent for now, but a big question is how long can it last?
So, Cam, I want to point out a tweet that was just sent out by our Jim Cramer just a short time ago. He's pointing that, at least this morning, investors are going back into a lot of speculative names. He mentions nuclear stocks, Bitcoin miners, also quantum computing, one of the more speculative trades out there, all those moving higher, up about 3 to 4% this morning. He also says you need to take some gains right here. Do you agree with that idea, or is there more room to run for some of these more speculative trades?
Yeah, for right now, it's been this sort of party on, Garth, with very low quality names leading the market higher. But we do think that you're starting to see, at least at the edges, signs that liquidity is starting to tighten. And that's really important for speculative, non-profitable, high beta parts of the market. You are seeing liquidity tightening. Look at Bitcoin trading below its 50-day moving average, maybe getting a little bit of a lift this morning. But if liquidity tightens, we think that that's going to usher in a period of lower returns for that low quality part of the market, and finally allow high quality to have a little bit of its time in the sun.
All right, Cameron, let's get to your pick. It is the DGRW ETF. It's a dividend focused ETF. Why right now?
Yeah, it is on that whole idea that quality is going to come back as a leader in this market. As you're getting into more uncertainty about the economic situation, maybe even growth slowing down, liquidity tightening, as I mentioned earlier, we think that that really sets a backdrop for high quality to do better in this market compared to the rally that we had off the April lows, which was just so led by low quality.
All right, Cameron, we got to go. One quick question. Look at the dividend yield on that ETF. It's about 1.46. If you look at the VOO and S&P ETF, it's about 1.15. But the DGRW is actually lagging the year-to-date performance, or the performance since the April lows. Does the dividend make up for that?
No, not necessarily. And what we think is that the reason it's lagged is because low quality has been the leader of the market. So as low quality starts to fade with tighter liquidity, we think that there's opportunity.